Every month, we all have bills that we have to cover. Things like housing, transportation, utilities, and groceries. But what if you could earn passive income that pays those bills for you in the form of monthly dividend payments just for holding certain stocks?
Stop lying.
I don't lie.
Now I know it sounds way too good to be true, but this is actually possible, though it definitely isn't going to happen overnight. That said, the sooner you start, the better off you're going to be. And to help you get there a little bit faster, I asked my AI assistant Tiara exactly what the best monthly dividend stocks are available right now. And here's how that conversation went. Hey Tiara, I'm tired of paying my car payment and want to find a way to have dividend stocks do it for me. Can you give me a list of the absolute best dividend stocks that pay monthly so I can buy some of them to make my dreams become a reality?
Of course. And it sounds like a great plan. Passive income is the holy grail for freedom to do what you want, and being able to help you cover your bills with dividends sound like a great idea to me. I'll start by listing out my top recommendations first, and then I'll explain my criteria and thought process for making these suggestions at the end.
Now, I like the fact that Tiara wants to jump right into the recommendations, and I know that that's what you're looking for, so we're gonna do it, but before we do, I have to give a quick disclosure. This video is not financial advice. It is for informational purposes only. Investing in the stock market, it does have risks, so if you're looking to do that, make sure that you speak to a professional and educate yourself. That said, let's go ahead and let Tiara do what she does best.
First, let's start with Realty Income Corporation. This company is so committed to monthly dividends, they've actually trademarked the phrase, the monthly dividend company. Realty Income focuses on freestanding, single-tenant commercial properties. Think of places like your local Walgreens or 7-Eleven. These tend to be stable, long-term tenants, which is great for consistent income.
Commercial property is a very interesting strategy right now. And while I haven't by any means done any of this myself, I can say that if I was a real estate company, I would definitely want billion-dollar clients like they have.
Here's why I think it's worthy of being on the list. 1. Realty Income has been paying monthly dividends since 1969. That's older than most of you watching this video. 2. Right now, it's offering a dividend yield of about 5.05%. To put that in perspective, if you invested $10,000, you'd earn about $42 each month from dividends, or $505 annually. 3. But here's the kicker. They don't just pay dividends, they grow them. They've increased their dividend 121 times since going public in 1994.
Now, this company has been featured before in another video that I've done for the best dividend stocks to invest in. And the fact that they have gone so far as actually trademarking the monthly dividend company, I think speaks volumes about why they're on this list. And, I think it's pretty obvious. Now, this next one on the list is also in real estate, but it's a different type of property altogether.
Let's move on to the next company, Stag Industrial, Incorporated. This company is all about industrial real estate, focusing on single-tenant properties across the United States. Stag Industrial owns and operates warehouses, distribution centers, and other industrial buildings. Think of the massive facilities where your online orders might be processed or where manufacturing happens. These properties are in high demand, especially with the boom in e-commerce.
Another really good tenant that really didn't come to my mind, but makes a lot of sense. Now, let's learn a little bit more about the business.
Here's why I think it's worthy of being on the list. 1. Stag has been paying monthly dividends since 2013, making it a reliable choice for those seeking regular income. 2. Right now, it's offering a dividend yield of about 3.79%. Which means if you invested $10,000, you'd earn about $32 each month from dividends, or $379 annually. 3. Stag is benefiting from strong market trends in the industrial real estate sector, including the growth of e-commerce and the reshoring of manufacturing.
Now, this is a really good business to be in right now. Now, I don't think anybody would argue against e-commerce and manufacturing because they're continuing to expand and they should be in the future as well. Let's see what else TR had to say about Stag.
4. While the dividend growth isn't as aggressive as some others, Stag has been consistently expanding its property portfolio. As of June 2024, they owned 573 buildings across 41 states, totaling a massive 114.1 million square feet. 5. The company's focus on single-tenant industrial properties provides a level of diversification, as they're not reliant on any single industry or tenant. 6. Stag has shown resilience during economic downturns, with many of their properties considered essential businesses.
I like this stock a lot. And of course, I know that any stock that's on this list, there's going to be risks associated with them, right? But on the surface, this one really does sound like a home run. And I know that this video is really for dividend stocks and that sort of thing, but honestly, this sounds like it could be a good recommendation just in general. The next company is in the financial sector. And from what I can see, they've done really well since their IPO in 2007.
Let's move on to Main Street Capital Corporation. This company is a business development company that provides long-term debt and equity capital to lower middle market companies. They focus on investing in established, profitable companies with revenues between $10 million and $150 million. Think of businesses that are too small for traditional banks, but too big for local lenders. That's where Main Street steps in.
Honestly, I think this is the riskiest investment so far because they work with lower middle market companies, but let's see what TR has to say about them.
Here's why I think it's worthy of being on the list. 1. Main Street Capital has been paying monthly dividends consistently since its IPO in 2007. That's over 15 years of steady monthly income for investors. 2. It's offering a dividend yield of about 7.69%. To put that in perspective, if you invested $10,000, you'd earn about $64 each month from dividends, or $769 annually. 3. They don't just pay monthly dividends, they also pay supplemental dividends. In 2024, they declared a 30 cents per share supplemental dividend on top of their regular monthly dividends.
I have to say, it's really, really rare to find companies that will give supplemental dividends in addition to their regular dividends. But as you saw here, Main Street actually does that, which is definitely rare.
4. They maintain a diverse investment portfolio across lower middle market, private loan, and middle market strategies, which helps spread risk. 5. The company's focus on lower middle market companies provides unique investment opportunities that are often overlooked by larger investors. 6. Main Street has never reduced its regular monthly dividend amount per share since its IPO, demonstrating consistency in returning value to shareholders.
This is another crucial point. One of the biggest risks with dividend stocks is that they will reduce or they will completely cut their dividends at certain times when, they're going through economic turmoil and having issues. Main Street has never done this. So obviously, that said, they have a history of always paying it out, which makes you feel very confident as an investor. And it sounds like it would be something that would be pretty reliable. Interestingly, this next one is also in real estate, but it is in a completely different sector.
Let's move on to the next company, which is LTC Properties. This company is a real estate investment trust, REIT, that specializes in senior housing and healthcare properties. They've been in the business of financing senior housing since 1992. LTC Properties focuses on providing capital to senior housing operators and post-acute care providers. Think of nursing homes, assisted living facilities, and other healthcare properties that cater to the elderly population. These tend to be stable, long-term investments due to the growing demand for senior care.
Baby boomers, that whole generation, they're growing older by the day. And that all said, there's a lot of them. So I don't have much doubt of this company on the surface, at least.
Here's why I think it's worthy of being on the list. 1. LTC Properties has been paying monthly dividends since 2005. That's nearly 2 decades of consistent monthly income for investors. 2. Right now, it's offering a dividend yield of about 6.23%. To put that in perspective, if you invested $10,000, you'd earn about $52 each month from dividends, or $623 annually. 3. The company maintained its dividend even through challenging times like the COVID-19 pandemic, which significantly impacted the senior housing sector.
Again, stability is a huge deal with dividend stocks. And the fact that they kept their dividend going through the pandemic when you know that the company was having a lot of issues, as an investor, it makes you feel pretty comfortable in knowing that those dividends are just going to keep coming.
4. LTC's portfolio is well diversified, with investments in 194 properties across 26 states and partnerships with 31 different operators. 5. LTC's focus on both senior housing, 53.3%, and skilled nursing facilities, 45.8%, provides a balanced portfolio in the healthcare real estate sector. 6. The company is poised to benefit from the aging baby boomer population, which is expected to increase demand for senior housing and healthcare facilities.
I was curious about this last point, so I did a little bit of research, and it turns out that there are 76.4 million baby boomers living in the US today. If any of the dividend stocks on this list would also be considered maybe a growth stock, this has to be the one. This market is very big and it's going to continue to grow for some time. Now, this next recommendation, this is one that is kind of, I've heard of it before. It's kind of a mix of both finance and real estate. You'll see.
The next stock on our list is AGNC Investment Corporation. AGNC Investment Corporation is a real estate investment trust that focuses on investing in agency mortgage-backed securities. These are residential mortgage pass-through securities and collateralized mortgage obligations for which the principal and interest payments are guaranteed by a U.S. government agency or U.S. government-sponsored entity.
This is a really interesting focus for a company. I think we all know that working for the government can be a ton of different headaches. You can have a ton of different problems, but obviously there are some perks as well.
Here's why I think it's worthy of being on the list. 1. AGNC has been paying monthly dividends since 2014, providing a consistent income stream for investors for over a decade. 2. Right now, it's offering a dividend yield of about 14.2%. To put that in perspective, if you invested $10,000, you'd earn about $118 each month from dividends, or $1,420 annually. 3. AGNC's focus on agency securities provides a level of safety, as these investments are backed by government agencies or government-sponsored entities.
So 2 things here. First off, a 14.2% dividend yield is very high. So that's obviously a good thing. Second is that if this particular stock plummets, it's really tied into the US government. So if it plummets, the US government is also plummeting with it. And that all said, there's a lot of collateral there, right? So just in general, if you believe in the US government, then you can, work with this company and hold this company. And essentially the company itself will really be working, but kind of the government's also working to make sure that you get your dividend payment.
Next is Armor Residential Real Estate Investment Trust. Armor Residential REIT is a mortgage real estate investment trust that invests primarily in residential mortgage-backed securities. These securities are issued or guaranteed by U.S. government-sponsored entities like Fannie Mae, Freddie Mac, or Ginnie Mae.
In the 2008 financial crisis, Fannie Mae and Freddie Mac, they were bailed out by the government to the tune of about $191 billion. So whether you agree with the premise or not doesn't even matter. It's just, as a company, it makes sense to align with these institutions because they're too big to fail.
Here's why I think it's worthy of being on the list. 1. Armor Residential REIT has been paying monthly dividends since 2011, providing a consistent income stream for investors for over a decade. 2. Right now, it's offering a dividend yield of about 17.19%. To put that in perspective, if you invested $10,000, you'd earn about $143 each month from dividends, or $1,719 annually. 3. The company focuses on agency securities, which are backed by government agencies or government-sponsored entities, providing a level of safety for the underlying assets.
Again, anything that's backed by the American government, in my eyes, is a winner. And I know that sounds crazy, but the reason is this. These companies, if they end up failing, unless there's corruption, within or something like that, if they end up failing, that means that the government is failing. And if the government is failing, we have way, way bigger problems than worrying about the stock market. I mean, that's when you get into civil war type situations, the entire government failing. We're not even worried about the stock market then. So that's why I have confidence in these.
Let's move on to EPR Properties. This company is a specialty real estate investment trust that invests in properties in specific market segments requiring industry knowledge to operate effectively. EPR Properties focuses on entertainment, recreation, and education properties.
This is another interesting market in real estate. Now, the thing that's interesting here is that everybody keeps saying with retail spaces that, hey, you have to kind of focus on experiential and experiences in order to bring people in. And it seems like this company, that's kind of what they do.
Here's why I think it's worthy of being on the list. 1. EPR Properties has a portfolio that includes about $7 billion in investments across 350-plus locations in 44 states with over 200 tenants. 2. Right now, it's offering a dividend yield of about 6.85%. To put that in perspective, if you invested $10,000, you'd earn about $57 each month from dividends or $685 annually. 3. The company posted second quarter earnings on July 31st, 2024, with adjusted funds from operations of $1.20 per share.
If you're not super familiar with stocks, this may not sound like much. $1.20, you're kind of like, whatever. That's actually a pretty good number for a dividend stock. It's definitely not a bad thing.
4. The company has $180 million committed for further experiential development and redevelopment projects, expected to be funded and completed over the next 2 years. 5. EPR's focus on experiential properties aligns with current consumer trends towards experience-based spending.
From what I researched with this company, they have a pretty big footprint. So right now they have right around $7 billion in properties, and they continue to buy more and more up. This next recommendation, admittedly, is a company I've never even heard of. And actually, they're not even located in the United States, which is kind of crazy. But I think after hearing it, you'll understand why it was recommended.
The next company is Pembina Pipeline Corporation. This company is a Canadian energy transportation and midstream service provider. Pembina Pipeline focuses on providing transportation and midstream services for the North American energy industry. Think of pipelines, processing plants, and storage facilities for oil and natural gas.
The government continues to push these environmental regulations, and I could see that being a hurdle at certain times for the company. But the reality is, in the next 50 or 100 years, this market just isn't going to go away, right? It might shrink with all the environmental things happening, but it's not going away.
Here's why I think it's worthy of being on the list. 1. Pembina Pipeline has been paying monthly dividends consistently, with a history of dividend payments dating back to 1997. 2. Right now, it's offering a dividend yield of about 5.76%. To put that in perspective, if you invested $10,000, you'd earn about $48 each month from dividends or $576 annually. 3. The company has a diverse portfolio of assets across the energy value chain, including pipelines, gas processing plants, and fractionation facilities.
Energy is one of those things that is just a basic requirement for society. So I think it's very unlikely that this company will just vanish.
4. The company has a strong presence in the Western Canadian Sedimentary Basin, one of North America's most prolific oil and gas producing regions. 5. The company's focus on natural gas and natural gas liquids positions it well for the ongoing transition to cleaner energy sources.
Now that you've seen the recommendations, let's make sure that you understand how TR is actually picking those recommendations and why her analysis makes sense.
As an AI assistant, I don't just look at current dividend yields when selecting stocks. I analyze a complex web of factors to identify companies that are likely to maintain or even grow their dividends over time. Here are some key factors that I consider. 1. Financial health. I dig deep into company financials, looking at metrics like debt-to-equity ratios, free cash flow, and payout ratios to help determine if a company can sustain its dividend payments. 2. Dividend history. I examine the consistency and growth of a company's dividends over time. A long history of steady or increasing dividends is a positive sign. 3. Industry trends. I analyze broader market and industry trends that could impact a company's future performance and ability to pay dividends. 4. Economic indicators. I take into consideration factors like interest rates, inflation, and GDP growth are considered as they can affect dividend-paying stocks.
I just want to point something out. So with economic indicators, I got to give my hat off to Tiara because that's a level of analysis that frankly, I don't really do that much. I probably should. So, that's definitely a good thing. Anyway, moving on.
5. Management quality. While harder to quantify, I also analyze factors like management's track record and statements to gauge their commitment to dividends. 6. Regulatory environment. Especially important for sectors like energy and finance, I consider how regulatory changes might impact a company's dividend-paying ability. 7. Competitive position. I also like to assess a company's market share and competitive advantages, which can indicate long-term stability. By considering all these factors and more, I aim to identify stocks that not only offer attractive current yields, but also have the potential to provide reliable dividend income for years to come.
I don't really know how you could argue with the rationale here. So on the surface, it'd be, well, what is the best dividend stock? That's not what Tiara is looking into. She's looking into many different levels deeper than that to understand a lot of other variables. Frankly, you and I probably, we are imperfect. We're probably not always considering those. A few weeks ago, I had a conversation with Tiara that I really think that you would like. So we had discussed whether or not dividend investing is actually worth it. So if you're interested in that video, I recommend that you click right here and you can watch it. Or if that doesn't sound like it's for you, you can click over here to see my most recent video. Now, before you go, if you enjoyed this video, please give it a like so that YouTube will recommend it to other people. And as always, make sure that you subscribe to the channel to unlock financial success one AI chat at a time. Thanks for watching.